Welcome to another episode of Life in Focus, where we dive into the world of real estate, the real life experiences and insights from our guest. I'm your host, Ben Tate, and today we are part 2 with Jean, diving back into the mortgage and lending world and good practices to, make sure you get qualified the next time you're looking to get a home purchase or investment property. So we're going to jump right into where we left off. We were talking a little bit about debt to income ratios, different factors that make you a qualified candidate to have a smooth closing, how quick we can close a loan. And we, ended the last part 1 rather talking about the different types of loan options. Not all of them, but just the 3 most popular ones, be it conventional, FHA, and VA. The down payment requirements that we typically see for each of those, and how much actual cash you need to get the keys for the house, right? So we use the example of a $300,000 house. And we said, just to recap, with a 3.5% down payment going the FHA route, you need about $11,000 for your down payment.
Yeah, 3.5.
Factor about $5 to $7 grand for your closing cost, and that's with no concessions being offered. So to be on the safe side, maybe $15,000 to $17,000 will get you the keys to a house. You own it, you have the closing costs, and now you're a property owner. And now your good real estate always appreciates over time. Now you're building your equity in that property. A conventional is going to be typically, there is as low as 3%, but typically it's going to be 5% as that threshold. So again, on that $300,000 example, you're talking about $15,000 down. Still factor probably closer to $7,000 for closing costs, maybe $7,000 to $10,000 to be safe. And so now you're looking at closer to $25,000 to get the keys. The good thing about going conventional is that you don't have to refinance to drop off your primary mortgage insurance. Again, we went over that in part 1 as well. You pay primary mortgage insurance if you don't have at least a 20% equity position in the property. So most cases when you buy a property, especially if you're buying a property at the market, the appraised market value, you're going to have zero equity in theory when you buy the property, which is why they ask for 20%, thus making your 20% equity contribution to the property, to the transaction. But if you put 5% down, now we just need 15% more equity to drop off the primary mortgage insurance. And so I advise to put 5% of your down payment, that 15% that you save in that example of $300,000, that's $45,000 that you're saving in a sense of not giving it to the bank to hold. Use that for value add opportunities, whether you're putting in a pool, whether you're upgrading landscaping, maybe you're upgrading the 2 bathrooms in the house, the kitchen, whatever it calls for. That's going to be a different value add for each property, so you can't see what your neighbor did and think you need to do the same exact thing. Maybe you need new roofs, impact windows, whatever the case is. You can talk to a licensed appraiser, you can talk to a realtor, or even a mortgage lender, somebody that's somebody that has an understanding of the market and what could add value to your property. That way you can spend the next 6 to 12 months adding value to the property with the money that you didn't give the bank as a down payment, and then call them up and say, hey, I'll pay you $500 for a new appraisal, instead of, because this is the thing, if you go FHA and you have a 1.5% lower down payment to go that route, anytime you close a loan, there's going to be closing costs. That's why you want to avoid having to go FHA. If you can afford the extra 1.5% to go conventional, that way you're just paying the appraisal fee to drop off the PMI, essentially, as opposed to having to basically reclose another loan, which again, we just said closing costs is going to be $5,000 to $8,000 in closing costs for that new loan. So you got to factor in that as well when you're thinking about monthly savings. So in a perfect world, you go conventional with the 5%, like I just said, use that extra 15% for value add, and over the time period of holding, you also hope that maybe interest rates go down, right? Because then if you did go FHA, you might say, hey, at least the interest rates are down. You don't have to replay closing costs. I'm going to get a lower interest rate that might offset a little bit. I might even save a little bit of money. But you got to remember too, after a property is purchased, it's going to be reassessed on the first of the next year. And so although most mortgage lenders do as best as they can to estimate what your increased taxes are going to be, it's not an exact science, and sometimes they're a little bit off. And so they might have underwritten you at $4,500 in taxes after purchase. You might be at $3,200 right now. They say, hey, it's going to go up. $1,300, you're going to be at $4,500. And then the county says, no, you're going to be at $6,000, And so, every $2,400 that you pay in taxes, that's $200 a month that you're going to pay towards your taxes, right? So when you start getting up to that $6,000, $7,000, $8,000 range, $600 a month is going straight to taxes, not even to principal, not even to interest, not to any of that stuff. But I want to quickly touch on concessions, right? Because a lot of the examples that we've talked about do not include concessions. Concessions, the answer is always no if you don't ask for it, right? If you have a good real estate agent, and it depends on the market too, are we in a buyer's market or a seller's market, right? Currently, right now, as it stands, October 2024, we are in a buyer's market, right? where you're not going to run into multiple offer situations as much right now.
Not right now.
You're going to find sellers that, because again, real life happens to everybody, right? There's a lot of things that can make a person have to move even if they don't want to. And so that once you decide that you need to sell something, as we are with anything, you get the itis. You want to sell that thing, right?
Oh, yeah.
Each day that goes by, you start freaking out. If I'm going to, can I sell this?
Can
Will
I sell it?
it?
Is it going to sell?
Or do I have to sell? All these things run through your mind. So, I say all that to say, when you're in a buyer's market, you have a better chance of getting concessions. And you got to remember, a lot of these, it's all situational, right? But assuming that somebody might have owned their house for 10 years, 20 years, 30 years, right? They likely have very nominal debt on that property, meaning that most of the money they're going to receive from that transaction is going to be cash to them, right? Equity.
Yep,
they're going to receive their equity back, right? So if I'm the seller and I'm selling that $300,000 house, my debt on that property is only $100,000. I have $200,000 coming back to me. For me to give you $2, $3, $4, $5,000 in concessions to get the property sold, to have a guaranteed closing in 21 to 30 days,
I'm doing it.
I'm going to do that because my time is worth money, and just to have a sure thing, right?
Yeah.
Because you don't want to get to 30 days and the financing contingency came through, they can't close. Now you're back to square zero, right?
Restart over with a whole new buyer.
Exactly. So for them to walk away with $195,000 cash or $200,000 cash, for them is a nominal difference. For you, it's everything, because now if they just gave you $5,000 in concessions, that might have covered almost all of your closing costs. So going back to that example of us only needing, on a conventional $300,000 purchase, 5% down. Now I can maybe get the keys for under $20,000 now because the seller gave me a concession for $5,000.
Yeah.
Right. So the answer is always no unless you ask. If you have a good real estate agent, they'll know how to ask. And the best way to ask for a concession, again, we're using the same example so people can follow along with the math. We're going to use $300,000 as our example this entire episode, right? But here's the thing. Instead of just saying, hey, can you give me $5,000 towards my closing costs? What you do is you say, hey, I see you have it listed for $300,000. I'm going to offer you $308,000. Right? That way, when you ask for that $5,000 concession or the $8,000 concession, they're still backing into what they listed that property for, right?
Yeah.
The thing you have to keep in mind, though, is the seller, obviously things have changed a little bit right now, but just going with how things standardly have been, the seller pays the commissions, right?
Yep.
They're still going to pay the commission based on what the contract price is, even if they're giving you a concession.
Yep.
So the seller still loses a little bit. So you want to sweeten the deal and say, listen, I'm going to give you a little bit more than what you're asking for, because again, you financing a $308,000 purchase or financing a $300,000 purchase, you're talking about $5 a month.
Yeah,
like you're not talking about
pennies.
It's pennies, right? So for you, it's not going to do anything to your monthly payment. For them, you're backing in, so they're not losing as much cash, and that's how you sweeten the deal. So I just think concessions are so powerful. I've used concessions on every single real estate purchase that I've done, and I've done a bunch. And again, as long as you have a good meeting of the minds, you always want to figure out where the other side wants to be, and then you figure out where you need to be.
Where you need to be, yeah. And I'm glad you touched on concessions, but so all I'll say on concessions is, so they're called seller concessions. For those of you guys that are not familiar with them, usually I've been on deals too, and most of my deals involve some seller concessions. Sure. But again, it's just like life, you don't get the girl if you never ask.
Yeah.
You got to ask. But that also takes whoever's representing you as a realtor to educate their client about that and say, hey, you do know there's something called seller concessions. We can ask the seller to see if they're willing to help you towards to see what percentage, or if they'll help you towards closing costs. My last deal back in September, I had this guy, and we were doing a loan. We were working a loan. Seller gave him 2%. He ended up needing a little bit more, so we had to amend the contract and actually give him more. I think it's like up to 6% seller concessions on FHA.
Yep.
So that's when but when I'm talking to the clients for mortgage purposes, we can't bank on that,
right?
Because that's not a guarantee.
No. So
I tell you, have your bread. X amount just in case.
Sure.
But we may not even end up needing that bread, which is great.
It's just another tool in the toolbox that
we have.
We need a Phillips, we got a Phillips.
But definitely for our viewers and people listening in today, know what that is. Get yourself a good realtor that's going to fight for you.
Yeah.
That's going to say, hey, my clients just had a baby. Like, they're going to need let's save them some money. Or my clients are just moved in from a whole nother state. They've got no furniture. Let's go ahead and try to help them towards that closing cost, and or just even have a little bit more left for emergency funds.
Absolutely.
People get sick all day, every day. Let's have them have a little bit more cushion in the bank.
And look at the time on the market, right? Most times if you see a property on the market, and in most cases, and again, Zillow and everything nowadays does a pretty good job of telling you when there's price changes, when it went up on the market, stuff like that.
Price cut.
But the point is if it's been on the market for less than 30 days, there hasn't been a price change. Typically what they list it off at is they kind of know in their mind they may not get that. Well, this is a seller's market, right?
Yeah.
But understand where the market's at today. If I list something at 300 grand, it's been on the market for 3 weeks and I haven't really got any hits, I'm probably already thinking about lowering it 2,500, 5,000, whatever the case is. And in most cases, just to give you a sidebar, if I want to sell the property, let's use the example. Let's say you want to sell a property and I want to get you to sign up with me to be the listing agent, right? And you say, listen, I've lived in this house for 15 years. I put my blood, sweat, and tears into these floors and this bathroom, my wife's vanity and all this good stuff, right? And you say, I know this is worth 350. And I'm saying, man, look at the comps. Like this thing is like 290, right?
Look at the
but I'm
comps.
not going to get this listing from you by telling you how wrong you are, right? So I have to approach that sensitively, right? I got to be like, listen, I hear you. Let's make a deal. Let's list it at where you think where it should sell. And if it doesn't have any movement, no showings, no calls on it, whatever, then we can agree that we can make a significant drop off the bat, and then from there make smaller
incremental changes.
Right. So that's what happens a lot of times. Is so that why when you see that first price up there, everyone kind of knows this is just pie in the sky. Let's see. Right. The answer is always no unless you ask. But let's be real about it too, because obviously the other side of the coin is it doesn't look good on the realtor side to show major price drops, because that means in theory that they priced it wrong, right? But again, they could be dealing with the homeowner that was like, I know it's 350, yada yada. So to appease them, let's say we'll start it off there. Let's make a big 25K adjustment off rip, and then from there we can maybe do 5K adjustments down until we get to where the market's at.
Well, yeah, that's important. That's important. So all good things, but glad we kind of touched on concessions. Good for the folks out there to know that you have that extra tool when you're trying to purchase a home, just in case you may feel like, man, I might need a little bit. I'm really close, but every dollar helps, and I feel more comfortable moving in knowing I got like a little cushion after I've paid this closing cost and down payment in case I get sick. Because that's how I think. I always got to say, hey, you got to always tomorrow. Things can change tomorrow. You buy the home today, God forbid you get sick tomorrow. You want to make sure if you're out of work for a month or whatever, you're not stressing like I just bought this home and I've got That's
a good point too. That just to touch on that is if you have some level of reserves, you should never be a candidate for foreclosure.
Oh, yeah.
Ever. Yeah. As long as you can keep them, you should know, like, okay, I just lost my job. I can pay another one mortgage payment, right?
Yeah.
Maybe I go open up a credit card to put some other expenses I normally paid off debit onto my credit to get another 2 mortgage payments of cash in my reserves, right?
Yep.
And then you go get a good real estate agent that can get that thing sold in 60 days, right? That's what you need to do. Because as long as you can protect the bank's money, your credit will be protected.
Well, and actually there's something called conditions so when somebody gets an approval, it's called a conditional approval. There's sometimes you'll see a condition on there that the client has to meet to show that they have 2 months of reserves, 3 months of reserves. They, on conventional loans, I've seen it where, hey, they wanted you to have a little cushion to kind of show you're going to be okay. Not only you're going to be closing, spending all this money, but you're going to be okay.
You're not going to lose tomorrow.
Ideally, mortgage or not, let's just talk plain life. Back to what I was saying. If your finances are not where they should be, and right now you're living paycheck to paycheck, your credit's in the dumps because you owe a lot of different people, please start paying on time. Start paying these people back. Stop maxing out. You've got a $3,000 credit card. You don't need to have all 3,000 of it used up. Let's go start chipping it away. I'm telling you, it's get after it 2024. So you can get ready for 2025 because all you're doing is you're just sitting on the sidelines, missing out on the potential to build equity because you've been waiting for the crash. I cannot tell you how many people have sat in the sidelines since 2019, 2020, 2021. Think about the equity would 5 years.
5 years
to tap into that right now. In case you are getting married next year, in case you do want a nice wedding, to know you already have that. Maybe you want to take out, take out some of the money from there. Maybe someone who has children going to college next year. Maybe you want to have this big life expense. Maybe you got sick and you need medical money for something. I mean,
just to give people an example, one of the properties that I purchased at the end of 2018, funny enough, got it for $300,000, right? I sold it in 2021. Interest rates were the best, so there's a lot of buyers in the market.
Yeah, it was a good time.
So I sold it mainly, and a lot of people say hold real estate, but the thing is, it hit my goal. I already had made 6 figures in equity of holding it in about 30 months, I think it was. It was less than 3 years of holding. 30 months, made 6 figures on that. that same house is valued another 6 figures higher than what I sold it.
Wow.
So that's a $200 and probably $60,000-$70,000 equity swing since October of 2018 till now. That just shows you how quick good property appreciates over time. And we can get, we won't get into it in this episode, but then once you build equity, you don't have to sell the property. You can refinance. You can take a loan against it. That's untact money.
It gets deeper. You can use that equity to buy another one.
House. Exactly.
Or I mean, that's a conversation that we will be.
We'll get into.
We'll get into the next time we meet together. But basically, though, is what we're trying to say is if you don't get in the dance.
Yeah.
You can't even. You don't even have a chance. You got to at least get in the dance.
Yeah.
And back to this whole quote of, okay, hey, but the interest rates are high. So what's the big deal with the interest rates, right? People always ask, what's the big deal with the interest rates, right? Oh, well, the interests are high. I'm waiting for the interest rates to go low. I'm waiting for a crash. See, you buy, and I tell it, folks, and maybe because I have another career, I'm not like thirsty, salivating to go close loans for people because either way, I'm going to get a paycheck. But and I do this mainly to try to help folks kind of like make that traction in life in advance and get and get better financial situation for them and their family
to learn how to grow.
Yeah, I'm not gonna. I always say this, so I'm not gonna beg anyone to make better decisions for their families.
Yeah,
I'm gonna make better decisions for my family. That's a guarantee. But I'm not gonna beg anyone to try to make better decisions for their family. They're the ones that will deal with the consequences. But what I would say is, buy. Hey, Gene, how do I know when it's a good time to buy? You buy when it's the right time for you and your family. If you know you're working hard, you've got a job, you're disciplined, you've worked hard to build your credit, you have the money. When you pay your rent every month, and it's all good because some people do have to rent for a period of time because they maybe want to get acclimated to the area, they want to get situated. But if you're in a position where you can have something that you can potentially tap into to get money, tends to be a great, usually, especially depending on kind of investment you make. You buy, decent location, all that stuff matters. The amount you bought it for, all that stuff. Why not do that versus it's December 31st, it's New Year's Eve, and here you go. You're gonna pay rent again in January. You never see that money again. Yeah. It's just you're not going to see it again.
I think the best time for somebody to buy, to your point, obviously when it's good timing everything's timing, right?
Yeah.
But when you have those four corners of the table that we spoke about, right? Like, if you are qualified to buy, you probably should buy.
You probably should buy
because you're gonna make money from doing that.
Yeah,
and the whole point is to make money while you sleep, help set your family up, create leverage, and create a history with the bank. If I go to you to get a mortgage, and you say, "Hey, you already had 7 mortgages before."
Yeah,
you paid them all off.
You are vetted.
Yeah, you're like, okay, this guy, the bank still wants to see those 4 corners. But I'm I'm the least riskiest buyer in that situation because I've already began my journey of leveraging somebody else's money and making payments on time.
Yeah, and basically, so the obsession with the rates and stuff is, you date the rate, you marry the investment.
Exactly.
It's
just noise right now.
The school district is awesome for your kids. It's safe. You needed that backyard. And it's the right size of home. You love it. It's great. Proximity is good to the highway, to shops, stuff like that.
Yep.
You love the town. It's cheaper than your rent.
Yep.
Those aren't going down either.
Exactly. The interest rate should never be a reason why you don't do it.
You don't the
interest rate that you get and I get, if all things are held equal, is the same.
Yeah, it's just. The obsession with that is something we see a lot. But we'll have to educate folks, and it's an educational piece that we kind of tell them, hey, you buy when it's ready for you, when it's the best time for you and your family. That's when you buy. Don't let all the other noise of all the other stuff distract you. Focus on the fact that we need a roof over our head. You got 3 options. You either own, you rent, or you don't. You unfortunately don't have a roof over your head. You need a place to stay. That's a non-negotiable. Yeah. Okay, so
and everything's relative too. Interest rates are high compared to where they were at the end of 2021, where you can still get a sub 3.
Yeah,
or maybe at the beginning of 2022, where you could get a 3.
Yeah,
and maybe you get a 5.5 to 6.5 now. So 2%, 200 basis point swing. That might be high relative, but what about in 2 years from now when it might be a 9?
Oh, what about the credit card payment that's 25%?
Exactly. Or the car payment that is 9% right now.
Yeah, you know what I mean? I mean, it's
so
it's an educational piece that we have to just keep on, because again, the last thing I ever want to do is make anyone feel like, hey, you've got to do this or pressure. No, I just want you to think. Make sure you think. Look at all angles here, and look at maybe the one thing that you may be tunnel vision on, or that you're just focused on that's prevented you from buying, and you could be like, wow, man, I've lost out 5 years. I'm thinking and worrying about the wrong thing. Let's make sure we look at the bigger picture here.
Let me ask you this: a lot of people are in domestic relationships, right? Pre-marriage, maybe marriage isn't coming, but they've been dating for 2 years, 5 years, 10 years, whatever the case is. Have you seen situations where boyfriend, girlfriend, whatever the case is, want to buy a house together, be on the mortgage together, be on the title together? Is there any additional hoops that they go through being more of a domestic partnership than an actual married couple that is trying to buy it? Is that instead of me living with my girlfriend and renting for years, does it make sense for us, if we have the cash, we have the four corners to our table, to go try to invest in a property together? Because I always tell people, if it works out, great, you start your life early. If you guys break up, you sell the property for 6 figures, you guys split your equity, go about your way and buy another house, and you're better for it.
So
what do you see on your end?
On my end, I would say, man, that's, it's going to be based on, their comfort level with, whatever they feel like with that relationship. But on my end, I get a lot of married couples. Cool. They buy, no problem. Spouse-wise, yes, I don't think you should let, just because you're with someone, you guys haven't been married, to prevent you from buying. I haven't had too much issues where people that are boyfriend and girlfriend don't buy, is what I would say. I would say,
as long as they're qualified with the credit score.
As long as they're qualified,
threshold, DTI,
everything is good. They know they're going to be together. I've got one right now. They're fiancéed.
I'm just thinking it might help with the debt to income ratio with another income and shared debts.
Absolutely. I mean, the more income we make, that's a good thing.
Right.
Which leads me to my next segue. It's October. It's end of October. Tax season will be here in 2 months.
Property tax season is here now.
Property taxes are here November 1st, in a week. But tax season in general will be here. Tax season starts January. Oh, great. Everybody's favorite time of the year. You got to do your taxes. I think I've spoken about this before on my page, but what we've seen certain times, and there's different loan products and stuff this affects, but if you own a business, people in these write-offs, and I'm not a tax professional, disclaimer, or anything like that, but people who write off their incomes and take all these massive losses, you're hurting yourself. If you know you're going to buy a house in 2025, you need income. Do not shoot yourself, like I said, in the long term, trying to help yourself out just short term because you want this big refund or something like that. First of all, be transparent with your taxes. That's probably a good thing to do.
Well, here's the thing, and I talk to people all the time because I'm in the small business world. The tax code is there for you to take certain write-off and expenses. That's what helps you, right? But like you said, if you have the foresight to say, hey, I want to buy a house next year, let me make sure when I file my taxes this year to not take as many write-offs, so to speak, as I can legally take. Right? But you can also backtrack that later on. Right? As long as it's documented expenses, it's documented through your business bank account that you have separately set up, or you have the invoices, receipts, you can say, hey, it's 2027 now. Back in 2024, I have these documented expenses from that year that I didn't apply. Right? You can forward that over. So for instance, the big thing is buying a car that's over 6,000 pounds, right? Because you can write off 80% of that in year one, right? So, but you're pushing off the expenses, the last 20% to subsequent years. So pushing off, you might not, because again, you can only write off what you have income to write off for, right? So if I want to write off 80,000, I have to have minimally 80,000 of income, or I can't just write off 80,000 and be negative, right? So inherently, if I only made 60 grand and I had 80K write off, I have to inherently push 20 grand of that to the next year anyways. So a lot of people, again, if you know you're going to purchase a property, just push those write-offs down the line. As long as they're documented and they're either through your business bank account or you have a separately invoiced document to show what those expenses are.
You definitely don't want to, if you make 100 grand a year, I mean, and then now all of a sudden, your tax returns, your tax transcripts for 20 are going to show me that you only made 30 grand. I can only help you out with this 30 grand.
Well, if you only make 30 grand, inherently, again, there's going to be some level of debt. obligation, and even if you guys see zero debt obligation, this would be a question you can answer. I'm assuming there has to be. So let's say in that same example, I made $100,000, I wrote off 70. You only see 30K of income, but then you say, hey man, you have zero credit card debt, zero social loans, zero anything, right? Yeah. But there still has to be some level of expenses that you guys have to assume from a basic living expense, right? So it's not just going to be 30. It's not going to be 100% for debt to income, right? You know what I'm saying? It's still going to be maybe 75 because you guys are still going to be assuming, okay, he's 10 grand of that has to go to living, right? Or whatever the case is.
Exactly. So do yourself a favor. Just be mindful. You need income, okay?
There's no way around it.
There's no way around it. The more income you make, that's a good thing, because then if you want a home that costs X amount, the higher chances of qualifying for that home, especially if you have minimal debt or zero debt. Especially if you have a lot of debt. You're going to need more income.
The only other way that I would suggest people that are small business owners and taking these large write-offs, the only other way that you can do it, and again, it's something we haven't even talked about yet, is the DSCR loan. That's the only other way.
Which we'll get into the next time we gotta meet all the different kind of products and stuff. But for the sake of it, though, today I just want to make sure, like we've touched some very basic stuff, but some key foundational stuff for our viewers is. You've really got to think, if you're gonna do something in that year of 2025, now is the time. Now is the time to get everything in order before you come. And if you don't know what to do and you don't know where to start, you need to come see me. Okay, so I can tell you, hey, you want to buy in March? It's now October. We got to get going. Let's clean this stuff up.
Like you said, go have that 15, 30 minute, whatever the time frame is, interview with you to say, listen, these are the things we're going to be requesting. Okay, I have 5 of those 10. Okay, now we know what 5 we need to work on. This is the income I'm going to be the income qualification that we're going to need from you to buy a $300,000 house. Okay, cool. So just, again, having the roadmap to where you want to be is so important to execute anything you want to do in life. So you got to know where you're shooting for. So we already know what our down payment and reserves need to be. Now we need to know, okay, what documentation. I need to make sure I have my tax returns handy. Some people only have the most recent one. I can't find my one for 2 years ago.
They never filed it.
Getting all that stuff in order. And making make it seamless as possible. But again, there's no harm, no foul in having a conversation with you or other professionals that are in your space to say, listen, what do I need? How do I get there? That way I can, even if I don't buy it to 2026, at least I have 12 months next year to get my stuff
get your stuff together, because some people do need 12 months. It's some people are ready today. And some people need 3, some people need 6, and some people don't. Some people are ready today, but they were ready financially today, but they don't need to, and they just kind of want to just get some information. Cool, that's fine too. And some folks, they really would like to do it today, but unfortunately they're just not ready.
So give us. Let's start with a horror story, right? A horror story, and maybe you can give us 2. Give us a horror story where somebody came in and maybe they already tried to put an offer on our property, which is almost impossible to do without pre-approval, but we won't even look at it. But, give us a horror story. Maybe that's somebody that was trying to get down the line, and you said, listen, we can't do anything for you. It's not even a personal thing. Nobody else can probably do anything for you from a financing standpoint. And then maybe give us a horror story where they got pre-approved with you, right? They got pre-approved. They had everything ready to go. And during the period that they were under contract, they went and bought a car. Or they got new client, they did something, they co-signed for somebody, right? So give us, walk us through a real life example of what I would call a horror story in that situation.
So there's, I got one. So recently, I was working on a loan for a client. We're going through everything. It's a special program called Florida Hometown Heroes.
And explain that real quick.
Florida, in Florida Hometown Heroes is a great program. It's been out for a couple of years now, and every time it comes out, to keep it very simple, there's X amount of money that Florida Finance, which is a special division or entity here in Florida, they come out with this X amount of money to help people with down payment assistance for folks that may need help, that extra help with their down payment. Cool, to help you
is that an income qualification?
There's income qualifications to it per county. This specific county, Lee County, where I was doing this loan, this borrower needed that program. Cool, right? We get to it. We're doing this thing. I talked to him about his debts and stuff. And even though he was getting the help with that program, we had issues. We had issues because the gentleman had so much debt. And here's an opportunity. And the money ran out in like 50 days, 100 million.
Yeah, that's crazy.
Came out July 1st. I think by like August 19th or August 16th, the money was gone.
For this program.
Yeah, for that program.
Yep.
So that's an example. We went through it, but he was working on various ways to try to have some money, come up with some money to pay down some of the debts so he could DTI. So that program was up to 50% DTI on the back end. Otherwise, then it goes away, it vanishes.
Right.
So
you need to get it done.
And we worked through it. But unfortunately could not come up with the money because he had so much excess obligations that he needed to meet. So you have that where we went through the process and, hey, I can come up with this money. So, okay, cool, let's give it a shot, come up with this money. But we could not come up with the money to get the debts paid off. So that was one. So that was one process of through gift funds, through things like that, through stuff you could get from family members. Then I have examples of folks who can't even get started because Hometown Heroes is 640, for example. I'm using that program, for example, 640 credit score.
Yep.
You know how I told you that 620 minimum for like FHA?
Sure.
For example, that's 640. See, lenders will have sometimes their own separate requirements.
Sure.
I got a lady. Hey, we need to get going. I'd like to purchase a home, Gene, etc. All right, cool. I don't have any issues. I don't have any issues. I'm like, hey, I always recommend like a Credit Karma. Like, let me just look. Let's look at that first. Let's look beforehand. No, I don't have any issues. We're good. Just pull my credit. We're fine. We're gonna do it. 540. We can't even do anything with that. You know, late payments, things like that. And those are the kind of things. But I had to talk to her and say, you want to do this? We're gonna have to do this. But like she wasn't even sure like when payments were needing to be made.
Sure.
Oh man, one was just late that week, and it dropped her like 33 points. Yeah. I mean, these things are hurting people left and right, and it's the things that they can easily do things about. Set reminders on your phone. Get together. Get organized. Get your finances in order, because you're gonna need it to get a mortgage. Yeah, it's just as simple as that. You're gonna. It's as simple as, hey, the disciplined folks shall be rewarded. That's through, like I said, that's through life with anything. Absolutely. From the way we take care of ourselves to how we take care of our finances. So
what about a success story? Something that came in maybe unsure and you were able to get across the finish line.
So I had a loan I did for a lady, and man, we ran into some hurdles because of the property. We're good, and this borrower's awesome. I'm talking credit score, well qualified, amazing client, but the property had issues. It's a condo, and condos in Florida.
Also, too, to cut you off, sometimes condos, or most times, require 20% as a down payment, and you can't do the 5% or the 3.5% for a condo.
Oh yeah. Some condos are crazy, but and this condo association did not have enough. They did not have enough of the master insurance policy that was required by the lender. It just wasn't sufficient. Long story short, borrower really wanted to move into this community, could not move into this community because the lender said, sorry, we can't land here. We cannot land here.
Yeah.
Distraught, etc. Cool.
Did everything right.
Did everything right. She's not her fault. Yep. Awesome. But cool. She had a real good realtor. We pivoted. We pivoted quick.
Yeah.
Found a single family home. Got her closed.
Sweet.
Within 3 weeks after that, because I already had everything.
Yeah.
It was just the matter of switching property. Got her closed. Happy with her home. Come to find out, that condo she was going to buy was also going underneath a lawsuit.
Oh no. So it's a saving grace.
Saved her twice.
Yeah.
So
that's awesome.
So that was a great.
So the things that you guys request and require to qualify an applicant, to qualify a loan, to qualify the feasibility of the transaction is protections on both ends. You're protecting the buyer,
absolutely.
You're protecting the business that you work for.
Yeah, see the investors that kind of like do the loans and stuff. They're not gonna. That was their guidelines. They weren't gonna write a loan at that property because it did not meet their guidelines. The insurance was inadequate at that property, and they weren't.
Yeah, it's their collateral.
And that's their. They weren't. So it wasn't gonna happen. And I had to explain that to her, and she was. as much she wanted to go and move there, but then later on she found that, okay, I wouldn't want to be in that situation anyway. So that's a real good example. Now, if you want to kind of just talk about some horror stories regarding like things that people have done that have hurt themselves even before that they can't even get started.
Yeah.
I've had a client who co-signed for a friend and the payment ended up not for a car, and the payment was not made. Payments weren't made.
So
Car went into repossession. Cool. Wasn't sure if it was still on there. Wasn't sure if it was still going to be whatever, right? We get into the process. We find out the repossession was still there. I was like over 10 grand. Asked my AE, that payment's got to be made. Some way, somehow, someday, he's got to pay that.
Yeah.
If he ever wants a home.
Right.
Well, because it's on. Well, and the thing is, he doesn't want to wait like forever. He wants a home. So he's like, you know what, I got to come up with a game plan to attack and tackle this. But back to the whole co-signing for folks. Yes, when you co-sign for people, be it a piece of furniture, a car, an apartment, those things will affect you down the line if you co-sign for folks. I'm not trying to say don't help no one out, but I guess you better really vet who the character of that person and who you're co-signing for, because you are going to be held responsible as a joint borrower on that account.
Yep. So to kind of end this segment a little bit, or I guess to end this segment rather, what's just the overarching advice that you would leave for a first-time buyer or a first-time applicant? I know we talked about a bunch of stuff, but just kind of hammer home, bullet point wise, top 3, top 4 things that they need to focus on. I know we talked about kind of a lot of the similar things, but
top thing I would tell you first-time applicant, someone wanting to buy.
Yep.
Keep your job. Keep your job. Be in good standing with your job. Seek employment, gain employment, have employment. You need to have a job. Try to keep yourself, in the same field as what you're doing. Obviously, the more income you make is great, but if you don't make like a crazy amount of income, don't automatically have this mindset of taking yourself out of the game either.
Right.
Especially if you're someone who has minimal debt and you're very disciplined, that's a good thing. If you are someone who is making a good amount of income, right now these are bullet points for you, and you have a lot of debt, you need to start chopping away at that debt. Start with your higher expenses, like your
credit cards, cars.
The ones that are the higher amount per month, because that stuff is going to affect your debt to income ratio. I already talked to you guys about the front end being just the housing expense. They look at that, which is the mortgage payment versus debt to income divided by your income gross pay per month, and then everything else plus that house payment. That's what hurts people.
Yep.
That's usually what hurts them to where they can qualify, the back end debt to income ratio. So if you know that you have all this debt that might disqualify you from future loan programs that are coming up, let's start chopping away at that stuff, because in collections, things like that, get that stuff taken care of. Get it taken care of. I think it's like $2,000 or higher on FHA. You got to pay it off anyways.
Yep.
So you got to pay it off anyway. So you're not going to get the loan. So do those things, save some money as best as you can. But by paying a lot of this stuff that's nickeling and diming you, then do it. And then just general of, hey, if you can't afford it, let's move on to something more sense. And then 2, maybe get in line with your budgeting. Get in line with your budget. You're coming in with only X amount per month, and you're realizing you're saving nothing. And sometimes sacrifices got to be made. Sure. We have a story. I think Cedric was telling me this, the owner of my mortgage company. He told me how there was a couple who really wanted a home. They both had cars, but they went ahead and moved into an apartment really close to their job. Got rid of the cars, so they didn't have the car payment. Just bike to work for a year. To save up money, and to save up money to be able to get a home, so they can meet that debt income ratio, and also to save money by not having these expenses. So that's like a good practical advice. Because certain times maybe you're a man, you got the itch, you got to get out your mom's house and stuff like that. But the relationship is cool. Your folks ain't bothering you, and you guys can stay there and stack up with your parents. What is if you're in 20s, 21s, 22s, 20 whatever, early 20s, you're living with your parents. You guys get along. Why not save some money, especially if your parents aren't
set you up for the rest of your life.
Great. I mean, it worked out for me.
Yeah. No, that works out.
And so those are the kind of simple things I would say. Reach out to a mortgage broker. Reach out to a professional.
I was going to ask you, how can we reach out to you?
To reach out to me, you can reach me at, I have my, I got an Instagram profile where I kind of have some successes, some highlights, stuff I've done. J is in J, the first initial of my name, J is in January, N-O, and the word mortgages.
JNO Mortgages.
JNO Mortgages. So reach me out, reach out to me through there. It has all my contact information, how to reach us, my phone number, my email. And we can kind of converse some more. My phone number is 239-321-2398.
Okay.
I keep it open for business. If you want to reach out, send me a text. Hey, we're CRS Group Mortgage, located in Florida, licensed in Florida. And we're here anytime that you guys have any mortgage questions. If you're on Instagram, like I said, or I'm also on Facebook. But that link is on that profile. If you don't have Instagram, you can just call me, 239-321-2398. Text me, whatever. And then, my email is on there. My email, Jean Noel @CRS Group Mortgages. That's C as in Charlie, R as in Richard, S as in Sam. Again, mortgage.com, So, I mean, I'm available,
Perfect. Hey, well, I appreciate the information and you spend the time to come up here during your busy schedule, working 2 full-time jobs and closing mortgages and saving lives and raising a family and all the beautiful things that you're involved in right now. So I really appreciate the time. And for those listening, again, figure out your debts, try to get your debts in order. Keep your job until you get approved for a mortgage. If you need to switch jobs, wait till after you get that mortgage and close on the house officially.
Yeah.
Switch jobs if you must. But more importantly, have these conversations with your local mortgage broker. If it's not going to be Jean, have these conversations to see where you stand, see where you need to go, understand that the money you need cash-wise to get into a property is not as much as you may think it may be. It's a lot more possible than you think. So, just having these questions answered allows you to formulate a plan that you could then execute. And I think that's important for everyone that wants to start this journey that hasn't yet. So again, I appreciate you taking the time to join us. We'll have you on many more times to dive into different loan products, specialty types. And maybe, this one was more geared towards people that are trying to purchase their first home. But we'll dive into a little bit more of the investor world. And, if you're looking for new construction and different things that are going to be a little bit, not as straightforward per se as the stuff that we're talking about today. But most importantly, to create a good foundation for yourself moving forward, you got to get your debt in order. You got to maintain your income. And you got to just have good habits when it comes to your budgeting and spending. Yeah, definitely. And I guess, let me see. One last thing I will say is thank you for the opportunity to come here. Absolutely. And we joke around and we say this, but yeah, as you're going through your loan process, and I know you wanted me to mention that earlier, please don't quit your job. Yes. Don't get fancy. Like once you've started, once you're on the clock, and it's rolling, it's like, you cannot quit your job. We had someone quit their job. 2 days before they closed on the duplex. That duplex right now probably would be worth, oh my gosh, this is like 2016. So don't buy a piece of furniture. I mean, they're gonna check this stuff, guys, before. Just wait till you close. Wait till you close. All you gotta do is get the keys. Get the keys. Wait till it's official. Just get the keys. Don't get emotional until it is official. So yeah, that time to go ahead and go to rooms to go and drop another $5,000 on a credit card. Just chill. Let's just get through the gauntlet. But that's all I've got for today. But yes, definitely next time we'll talk more specifically about products. Absolutely. There are some great things that the government's doing for underserved areas, like home ready products, things that gives people grants. I'd love to chat to you guys about those things. The credit scores that are required from the DTIs that are required for them. Those products are happening because we realize there's like underserved areas to help people. Sure. Who are trying to get into a home due to the fact that we understand that home affordability is also hasn't been the easiest in the last couple of years. So we're aware of that too. So be mindful. We do have those things out there, and we work with the #1 wholesale lender in the country, and we move pretty quickly. Remember that loan, September 3rd? It was submitted by CRS Group Mortgage. September 16th, we got clear to close. That's 9 business days, folks. Yeah, 9 business days. That's insane for financing. To get clear to close. But yeah, we'll get into all that next time. And we appreciate you guys listening and following along. Like, subscribe if you haven't already. We'll see you next time. Thank you.